Well, good morning. Happy July. I mean, gosh darn it. Last week was the 4th of July, so we didn't do market trends.
No, well, I had jury duty.
You did have jury duty.
Which is why we didn't have it. And it was a really horrific.
It was.
I was the last juror to be excused.
Yes.
I was 4 out of a pool of 100. It was for a murder and dismemberment case. And it was awful. It was awful. Yeah. I'm so happy that I got excused. I don't even watch true crime. I don't watch horror stories. And I was like, if you expose me to this, I'm going to have PTSD. I'm not going to be okay.
And I love detective shows. And I was like, that would be kind of cool.
I couldn't do it. No, there's no way. And it was going to last 2 weeks. And I was like, this is not, I can't. I was like, I'm all about doing my civic duty. And I would have served as a juror had I been chosen and done my job. But I like to sit through that and to see the crime scene and all of the details about that. There's just no way. There's just no way.
That might have actually been one I would have stayed for, but I have not been chosen for jury. I better knock on some wood.
Yeah.
I've been chosen. I always get excused very quickly. So here we are. It's summertime. And I was kind of thinking about the quote this morning because I've been talking to a ton of agents about what's going on. Like some folks are seeing incredible business and others are just hearing crickets. And it's really trying to judge where you're at comparatively, right? I mean, the market's gone down for all of us, but am I still okay is kind of a question that you internally start to process. You know, where am I relative? So where do we go? We go on social media, which is the worst place to go.
I know. Oh, I've been so bad about death scrolling lately where I just sit there and scroll and I'm watching TV and I'm scrolling. And I mean, I've got to get off this. I got to I read a book.
You read a book.
Go outside.
Do anything. Take a walk. So I've been looking at social media too, and I'm super self-judgy. I don't know if you are. I'm super self-judgy.
I'm always comparing myself to everyone else. I'm like, I gotta be at the top of the leaderboard.
So competitive. So that's where this quote came from, because I have been talking to some very close friends and we're all kind of doing the same thing. Like, but he's super busy. He just had a closing. She's crushing it. She just had all of these closings, whatever the thing is. And it took me back to a Michael Phelps quote that I have repeated a number of times, but I actually saw this one from Simon Sinek, and anything from Simon Sinek is kind of dreamy. I'm just going to say that. So I chose the Simon Sinek one instead of the Michael Phelps one, but it's the same concept. He said, we achieve more when we chase the dream instead of the competitor. So setting your vision, we're halfway through the year, which also kind of freaks me out. We're at halftime and we have the option to recast our vision, to describe it and to proclaim it and to go after something really incredible the second half of year, right? And the economy is not going to give it to you. There's not going to be a gift in the second half. What you get is what you're going to make of it. So chasing a dream, a vision cast so strong that it literally comes from within you and starts to create itself. That's what you should be focusing on, not what the competition is doing. In fact, go the other way, create something unique and really different for your clients to experience. And you might just be on the leaderboard come January and February, right?
Yep.
So with that, Miss Megan, quiet July, how you feeling about the market?
Oh, so I feel like everybody just took the first 10 days of July off and then orders started coming back in again this week.
Okay.
But it was with the 4th of July falling in the middle of the week last week on a Tuesday. That didn't mean a 3-day weekend. It meant a 4-day holiday weekend.
Yes.
So more people were out of town over the 4-day holiday weekend. And then they kind of trickled back into town the following week. And we typically experience a little bit bigger of a bump of activity right after July 4th over the next weekend, but it didn't rebound quite like what I was hoping for.
I don't think anything in the market's rebounding quite like we're hoping for right now.
No, it's not.
And somebody said next year's the 4th of July on a Thursday. I have to check that out. So it's another 4-day weekend.
Leap year? Yeah. Okay.
While you're talking, I will double check that.
Okay. And so, yeah, that makes for a weird week when we have that 4th of July fall in there. But our market is really downshifting right now from that hyper competitive market that we had from March through the beginning of May. And then in June, we started to feel that slow down a little bit more. We were roughly flat going from May to June.
Right.
And then we expect there to be less activity as we get into July. So we've already passed our peak of real estate season. And so it's really important that you guys are using strategy in talking to your clients right now about what's happening in the marketplace as we start to downgrade into the back half of the year. And so I wanted to go over some of the detached single family June statistics with you, so that you guys got that. And then we'll go over the beginning part of the weekly update so that you guys could get that. And I'll be, of course, sending everything out to you guys as soon as we're wrapped up here. And I get my email list all updated and the recording all set.
I like the idea of the strategy the second half. I mean, I was listening to a podcast yesterday that a couple of real estate agents actually sent to me through the Buffini group, and they were talking, Dave Stevens was on it, and I love Dave Stevens, and he was talking about this hope that we might actually see interest rates in the 5s by the end of the year.
Oh,
I know, in the high 5s. I'm a little hesitant to go say that and to claim it. But I was looking at MBA also has some estimates, which I'll show you in the back half as well. And I'm kind of going, all right, let's push this to the side. We saw what the CPI did. The CPI dropped us back into a range where people have been accepting the interest rates for the last 5 weeks. And my thought in all of this is, with all the news, and we're going to talk about it, Megan's going to go over all the details in the numbers of the real estate, and I'm going to talk about the economy on the second half. I keep thinking, how are we incorporating all of this data and information into conversations, right? So whatever happens over the next 6 months, how are you stacking up the pipeline for the spring or for next summer? Or maybe you're even blessed the second half of this year, right? But how are you continuing? Don't get disgruntled with any numbers for the second half, but instead get really excited about the opportunities that you continue to present.
Right. Well, now's a really good time to start laying that framework for people that want to sell next year. Because if their yard looks beautiful right now and they want to list in next spring, now's a great time to go out and do those drone photography shots, or do your twilight photos while people have their flowers blooming and their yards looking nice, so that they get a sense of what that space looks like, because you want to have that instead of snow pictures if you're going to list at the beginning of next year.
Oh, I really like that.
And so this is a really good time to be reaching out to your database to see if they're interested in listing their house next year, or if they have a move that might be coming up, so that you can get the photography taken now. Yeah.
Now it's a planning time. I like it.
Definitely. So let's go ahead and hop into the detached single family report for June. This was sent out last Friday for you guys, so you should all have a copy of that already. Looking at what's been happening with going into June. So this is for detached single family only. The attached market ended up lagging, and we ended up adding a ton of days on market to the attached single family residences, but that market has been lagging. It hasn't been going quite as great. But overall, when we were looking at detached single family, our active listing count was about 3,600 available listings for sale in the month of June, at the beginning of June. And our active inventory only went up by 2.4%, and new listings went up by about 10%. But keep in mind that our new listing count going into June was 29% lower than where it was 1 year ago going into that year. So our inventory is remaining incredibly tight.
Right.
And so what I think is that our retraction phase might be less significant this year. And we'll go into that in a couple of slides where we end up seeing that fall back in prices in July, August, and September. Keep in mind that we tend to lose about 5% of our average sales price that we've built up during the run up in our spring months because of that flip in that inversion between supply and demand, where we end up having more supply and less demand as we get deeper into the summer months. But inventory is still historically tight. And so when we look at where we should be baselining off of 2013 through 2019, I mean, historically in the month of June, we had 5,900 attached units available for sale, whereas right now we only have about 3,600 available units for sale. And so again, people aren't moving this year unless they have to. And so again, I go through and I ask those 4 questions, or I try really hard to reach out to all of my clients each week that send me in new transactions. And I say, so how long were you on the market? Did you get multiple offers? How far over asking price did you go? And why is your seller moving? And the most common answers that I'm hearing is birth, death, divorce, change of a job. And so people are having life event changes that are making them move right now is why people are moving. Pending transaction count was basically flat from May to June, about 2,900 units going under contract, whereas historically we'd put about 3,900 units under contract. And it was kind of interesting. I was in a meeting with RE Colorado yesterday, and I was like, so what are you seeing for your attrition rate right now for realtors? And they said about 3% have gotten out of the business.
Which is super low.
Considering how down our market is in terms of overall closed volume, and there are fewer transactions available per agent, people are still still hanging in there and keeping their license active. Now, they projected that once board dues become due going into October, that what they're likely to see is that people may drop their realtor affiliation and go to a non-realtor status. And I'm a big fan of being a realtor.
Yes.
I like the code of ethics. I support the boards, and I would hope that you would keep that activated, but they expect there to see a transition of people going from realtor to non-realtor in order to keep their license active and still have access to the MLS system. Closed transactions were up slightly, only by about 100 transactions. Again, about 2,900 closed transactions, whereas we normally close about 4,000 in the month of June. And you can see that it starts to drop off pretty drastically as we get into the back half of the year. Month supply of inventory broken out by price range. We were looking at about $400,000 to $600,000 at about 0.8, $200,000 to $400,000 at 0.7. Keep in mind that when that number is below 1, that means that we have more buyers in the market than homes to sell those folks. So that's where we're going to see those multiple offers, or those homes that are under $800,000 right now in those conforming loan limits. But once we go over 800, or once we go over 600 to $800,000 right now, we're at 1.2 months worth of inventory, which was a jump over 1 month of inventory. So the multiple offer market has softened, going from 800 to $1 million. As you get into 1.5 to 2 million, we're now up to 2.7 months of inventory, 2 to 3 million at 3.6, 3 to 4 million at 3.8, 4 to 5 million at 6, and 5 million or more at 4.3 months worth of overall inventory.
Really goes up there.
Yeah, it does. And so, I mean, overall, we're still considered to be in a seller's market, but it does soften a little bit more at the top end of the market. And what's really interesting is, again, there are these ultra luxury buyers that are in the market right now, but they don't want projects. They want these perfect turnkey homes that don't need a lot of work to move into. And what I'm seeing, which is really interesting, is we ended up having, I think it was 5 transactions that closed over $5 million last month. And 4 out of 5 of them were over multiple offers. And they were significantly over asking price. And we'll go over that in just a little bit for you. But it was interesting to see, and it was 5 or 6 transactions that closed over 5 million. And so, but 5 out of 6 or 4 out of 5 were all in Cherry Hills Village. Cherry Hills Village has been really hot lately, versus other areas have been a little bit cooler. And that's what this map shows, is our month supply of inventory broken out into the top 105 zip codes that I track and trend on a monthly basis. And you can see that those inner landlocked ring suburbs are really where we're still seeing the bulk of our transactions being in multiple offers, where we have less than 1 month worth of overall inventory. Something to note is that our central Denver market, even for single family detached homes, have started to really cool down. And so even getting into places like Low-High in the Highlands, we're now sitting at 2 months worth of overall inventory. A couple of months ago, I went through and I was touring some duplexes and some higher end luxury listings that were between $1.5 to $2 million in Low-High. And they had been sitting on the market for 30, 45 days, and we're looking at trying to make price reductions. And I've seen a lot of agents going through and now putting those in a dual status for MLS. They're saying that they're either for sale or for lease.
Okay.
Yeah. And so people trying to lease those properties out rather than trying to sell them, because they're not moving right now and they can't get the price that they want for it right now. The Lodo market still remains cool at about 4 months worth of overall inventory. So for every one buyer in that market, they have about 4 different units to choose from. Getting here into what is this, like Alamo Placida, just north of Wash Park. Wash Park is also sitting at about 2 months worth of overall inventory right now. Still cooler in Sterling Ranch at 2 months worth of overall inventory. Castle Rock at 1.6. A little hot spot getting down here into Larkspur at 1.15 months worth of overall inventory. But again, hottest zones, Lakewood, Littleton along the 225 corridor, north into Westminster below 1 month of inventory, portions of Westminster that are out further north and west at 0.6. Arvada has cooled off slightly. It's still red, but it's not as red as it has been for the last few months. We're going to flip way ahead, and we're going to talk a little bit about pricing and strategy as we get into the next couple of months here. So sold price ratio, some of the good information about this is that our sold price ratio, or close price, ended up going up 1.7%, but our median sold sales price went down by 0.5%. And so kind of a mixed bag there overall. when we're looking at what ended up happening with did prices go up or go down? And so I tend to bank more on the median closed price going down over the last month, because that's really where the meat of the market is. When you're talking about the difference between an average and a median, average sales prices can be skewed by really low and really high priced properties, whereas the median really represents the middle of the market. But we ended up with a $796,000 average sales price, and year over year, we ended up catching up. We're only down by 0.8%. I still project out that when we end up, and Nicole and I are in disagreement about this, when we go through and average out all of 2023 versus 2022, I still think we're going to be down between 2 to 4% overall on average. You think we're going to be flat?
Well, I'm looking at more appreciation.
Yes.
So I think appreciation is going to be flat.
Okay.
Yes.
And so I think it'll be kind of interesting to see where that shakes out as we round out our year.
Because I mean, you're even seeing that if we have more inventory, although it's going for over asking at the higher price points, if things are moving at the lower price points, it's going to pull that down. It doesn't necessarily mean people are losing value.
Right.
So it's a good conversation to have and keep that perspective for your clients.
So this is what's really important to talk about with your clients right now is this graph. So this graph shows on average how much prices go up or down each month as compared to the last month. And so when the bar is over the zero mark, that means the prices are rising. When it's below the zero mark, that means that prices are falling. And so as you can see, going into June, historically, we go up by 1.1%. We went up by 1.7% if we're using the average. And then going into July, August, and September, this is where we end up losing 5% of everything that we gained in the first half of the year. Now, in the first half of the year, average sales prices rose by 11.9%. They're going to come back down by 5%. And so again, we could end up seeing that we're going to land somewhere around the average prices. Not when we average out all of 2022 versus 2023, because we had such an extreme run up in 2022. But overall, that we'll see that we gained back from where we lost in the second half of 2022, about 6% of that overall price. Going into October, November, and December, it's either 1% up or 1% down. We basically stabilize at that point in terms of our prices, and then our market cycle ends up kicking back off as we get into February, March, April, and May. And so again, getting geared up for what's going to happen next year by starting to lay those bricks in your foundation right now, going out there, getting photography of those listings and getting them ready to showcase for next spring.
Yes. I mean, because so much is dependent on the Fed, so much is dependent on inflation, things that we can't control, like the financial markets right now. And so instead of trying to figure out when the interest rates do drop, if we go into this, and we're going to show like everybody is resilient right now. Did you know that we had, we talked about this when we were in person last time, but the first half of 2023 was the best first half in the stock market going all the way back to 1983.
You're kidding.
We have a ton of money right now.
You're kidding.
So this strength, these people are spending money, and that's why we're seeing so many cash buys, right? So to say right now that when the interest rates might go down or might not go down, we're going to continue to see people buy because of life. We're going to see people take advantage of opportunities that are presented right now. And then in the spring, if we see that we went through a soft recession and interest rates start to drop, it's going to be crazy.
It's going to blow up again. It's going to blow up again. This is why now is such a great time for buyers to be in the market. And if you can get a 3-2-1 buy down, you can get a 2-1 buy down, you can refinance, and you can be in a much less competitive market environment right now than if you choose to wait until next spring. And if rates drop down into 5.5-6% even, it's going to spawn all of this activity. So to try and get in the market now, rather than waiting and having to overpay significantly again as we get into the market next year. And so I would highly encourage your clients to consider moving this year rather than waiting until next year.
Agreed. 100%.
Let's go ahead and take a quick look at multiple offers, and then we'll hop into what's happening with the rest of the market. Multiple offers. And I've had a couple of really interesting conversations with clients lately about how do you measure multiple offers? Well, I can't measure how many contracts were submitted on a property. What I can measure is if it went for over asking price, if it went for a full price offer, if it went for under asking price. So that's what I look at.
Makes sense.
Now, I've had a couple of conversations with clients, and it's been 2 in the last week. They say it was really interesting. I had multiple offers. I had 5 offers. They were all under asking price.
If it's been sitting on the market.
I have no way to measure
Yeah,
those
to know that.
transactions without calling every transaction that
Makes
goes under
sense.
contract and getting that information out. And so, you know, maybe at some point in the future, when I have all of this spare time, I will start a sample surveying process of you went under contract, you know, tell me a little bit more about this transaction to get a gauge on the marketplace, but it would have to be so timely and everything. There's a lot of moving pieces to going through.
I would not even throw that ball out there.
I don't know.
Throw that ball out
I
there.
know. I only work 70 hours a week.
Yeah.
What's another 10?
Who needs to sleep?
I know. Right? So looking at where we were for over asking price, it was 41.1% sold for over asking price, which declined by about 4.7% as we closed out June. 22% went for a full price offer and 36.3% sold for under asking price. So about 4% more sold for under asking price, indicating that our market is cooling ever so slightly from where we were earlier this spring. Now, here's where we break it out into price ranges for you about what percentage are selling for over asking price. And that $200,000 to $400,000 mark was 51.8% selling for over asking price. And then it declines from there up until that $2 to $3 million mark at 17.6% selling for over asking price. But then look how competitive we start to get as we get into this $4 to $5 million mark. Again, there were about 5 transactions that closed in there. 80% or 4 out of 5 sold for over asking price. 5 million or more was 44.4% selling for over asking price. But overall, it was about 41.1% sold for over asking price last month. Now, this map shows you how many multiple offers or what percentage of listings are selling for over asking price as you get into the different zip codes. And so you can see the red areas are more competitive. We're getting up to, in some places, 75.5% of them selling for over asking price. Specifically over here, just into the southwest portion of Denver, looking into Littleton and Lakewood, we're about 45 to 55% selling for over asking price. Getting into Central Park, out into Northeast Denver, we were at 60%. Into this portion of Westminster, we were at 61.5%. Into North Glen and Thornton at 70%. Roxborough Park came in at 50%, but cooler, as you can see down here onto the south and the east sides of town, where it's bouncing between 17 to 30% selling for over asking price. South of the airport, 20%. Out into Candelas and Lion Rock, about 16% were selling at over asking price. Here's how far over asking price people had to go if they were in a multiple offer situation. And for everything that was under $1 million, you're between 3.5% to about 5.5% over asking price. 1 to 1.5 at 5.1%, 5.7% at 1.5 to 2 million. 2 to 3 million was 16.8% over asking price.
Yes.
And so $229,000 over 3 to 4 million was 115. 4 to 5 million going for 12.8% over asking price, and 5 million or more at 12.6% over ask, or $887,000 over the asking price. So those are really significantly over asking price properties.
A lot of money.
A lot of money going into those transactions right now. So if you have one of those ultra luxury listings, if it is staged well, if it's in great condition, in a great location, you are likely going under contract in the first weekend with significant multiple offers right now.
Right.
And so, I mean, it's not many of them. We're talking about 10 transactions that are over $4 million right now. But those ones that are going up for sale are really getting some really crazy offers. This shows how far over asking price you have to go if you are in a multiple offer situation. And so out here onto the south and the east side of town, you're looking at about 2 to 2.5% over asking price. Here into Centennial and Greenwood Village, we were at 7.1% over asking price. Broomfield, while there weren't very many multiple offers up into Broomfield, it was 10.5% over asking price. And as you get out here to the west of I-25, as long as you're inside of that C470 ring, you're between 3.5% to about 7% over asking price right now. We'll stop this share, answer a couple of questions, and then we will go ahead and hop into the weekly report and get out of that. Let's see what questions you guys have for us. I used this price appreciation chart in my listing appointment yesterday. So helpful to sellers to understand the summer shift. Awesome. Thank you so much for using that. I really appreciate it. That would be cool if you could talk to RE Colorado to add in multiple offer yes, no, and changing the status to pending. That would be a great idea. I don't know. I wish there were another way for me to track that. Because I don't know. I wonder if everyone would be forthcoming about if they had multiple offers or
Right.
not.
Maybe it's a pride thing. I'm just gonna click yes.
Yes. Yeah. Yeah. So
Right.
I would wonder. Thank you, Megan. Question for you both. Who are the buyers currently purchasing $2 million homes? Are they financing or purchasing in cash? With mortgage rates so high, I think they'd be less likely to finance, but with investment accounts offering 5% plus interest rates on cash, I'd also think they'd be less likely to use their cash.
I'm seeing both. We have several higher, you get beyond that 1.8 to 2 million and they're out of my realm. They're usually going with a private banker relationship. They're going back to their Merrill Lynch account, representative or something like that. And you can lean, those investment accounts to purchase a home. So we're seeing a lot of that, but we're seeing folks that do have a lot of cash. And if they have stocks, they're doing really well right now, especially if their chooser's not broken. They want to pull some money out to purchase some of these homes, but they don't want to pull it all out.
Right. And so I would say that about 40% are over cash or in cash
In that price
over
point,
$2 million right now. I've got 4 minutes to go through.
Oh my gosh. And
the next presentation. So I will hop into this really quick. And we'll get this up here for you guys. And I'll just go through the first 5 slides for you. So, and then of course, keep in mind that I go through and break this out by price range. Am I sharing this whole screen? What did I share?
Okay. That screen.
Okay, so slideshow from beginning. And so again, this is a really handy graph for you guys to use as we're talking about the heating and the cooling trends as we go through our seasonal cadence in Metro Denver. But you can see here across the top, here's our target listing month. Here's our target closing month. Listing as we get into late July, expecting a September closing, you can see that we start to cool off, especially as we get into the back half of July. Looking at our heat sheet for the week, this last week, we ended up seeing that our cooling trend continued. I was hoping for a little bit more of a pickup until right after 4th of July weekend, where we tend to see a little pop of activity, but that actually didn't happen. Something that was really interesting this week is usually we see about 3 to 5% increases in our average daily active count week over week, going from about May until September. But this week, our average daily active count actually went down by 2.4%. And so we had 531 or 5,391 total listings available for sale headed into last weekend. And that was down by 1.4% from the same week 1 year ago. So we actually have less inventory than we did a year ago. And so I thought it was interesting to see that average daily active count fall. That's atypical. New listing activity over 4th of July weekend. The reason why this number is so high at 47.1% is because no one was listing over 4th of July weekend. Our new listing activity going into Independence Day weekend was down significantly. It was down by like 50% versus the previous week. Our pending transaction count from before 4th of July weekend to after 4th of July weekend rose by 9.8%, with 943 units going under contract. And again, that's down by about 20.6% from where we were 1 year ago. Overall, we're sitting at about 1.3 months worth of inventory. Over Independence Day weekend, we popped up to 1.5 months worth of overall inventory. And so we did come back down, but it didn't drop back down to where we were before 4th of July weekend as we got into June. Month supply of inventory has the tendency to grow after 4th of July weekend through the end of the year. And so as you can see from last year, here's our big run up in month supply of inventory. Thanksgiving weekend, this is the weekend between Christmas and New Year's where things really slowed down. We got up to about 3.4 months worth of overall inventory. And so we'll see if we have this big run up again in the softening as we get into the back half of the year. I really don't think that I don't think it's going to soften as much this year as it did last year.
It was a shock last year.
Last year was a shock to the system with interest rates going as high as they did, as quickly as they did. But I think that people have adjusted now to the fact that we're now in this kind of different market and they're getting over and beyond that.
We popped above 7%. So we went to 7.22 the week before last. So, less with the holidays and unemployment numbers and the job numbers and all of that. We dropped just down below 7% again. And it got busy again. Like it doesn't have to go all the way to 5 right now. Now, granted, you still have 64% of people are sitting on the sidelines, but you're right. 100%. The buyers have gotten used to that.
Yeah. Yeah. Looking at the odds of selling, they increased week over week by about 1.2%. I was hoping that that number would come up by about 2 or 3% more over after 4th of July weekend. But you could see that it definitely cooled going from the last week in June down to 4th of July weekend. And then it popped back up again as we got into this last week with a 55.3% odds of selling. And so again, historically in the month of July, we see about a 50% odds of selling. So we're still doing better than what we experienced from 2013 through 2019. Where we are in terms of balance right now, we're sitting at about 21.9% of an overall market in balance, where we would need to have about 24,500 available listings for sale. Showings this last week, they popped up from Independence Day weekend by about 26.7%. And so that was about 13,000 total showings that were set. So it was about 2.4 shows per property per week as we looked at the overall market. People were out looking last weekend, but they weren't putting as many units under contract. And so it was only about 14 showings to go under. It was about 14 showings to go under contract, which was up week over week by about 15.4%. So people are looking, but they weren't jumping this last weekend. Median days on market over Independence Day weekend and last weekend both sat at 12 median days on market. As you can see, going into the later part of 2022, how long days on market ended up stretching out for those units going under contract. I don't think that we're going to see that big run up again. Inventory is just too tight this year. And we seem to have this baseline level of demand that continues to keep it low and keep it churning this year. For price reductions this last week, they declined by about 1.9%. So we saw for the units that went under contract this last week, about 32.2% of them decreased their property, 2.6% increased, 65.1% remain unchanged. And the price reduction went up this last weekend, where it was about a 5.1% price reduction overall. Keep in mind that I do have this broken out for you in a $500,000 price segment, so you guys can go through and flip through those slides once I send those out to you by about noon today. And so I should be getting those out to you as soon as the video is done rendering. I'll have those out to you. Let's go ahead and answer a couple of questions, and I'll turn it over to Nicole. How is Virginia Village doing as far as sales over asking? Nicole, if you could do me a favor and shoot me an email with that zip code, I can take a look at that zip code for you and tell you what's happening in Virginia Village. I know that that's in Eastern Denver. Is that right?
It's right by Colorado and I-25.
Okay. Yep. So send me that zip code and I can take a look at it. Aller, ALLER at firstam.com. Looking at the last slide, you were referencing 4th of July weekend, but it looks like the graph shows June. Am I reading this wrong? So the one that I was looking at, it doesn't track every single date on there because I have too many dates that are on there. It does go through this last weekend of the 5th through the 11th. And so it does show that on there, but it doesn't show every tick mark just because I've got too much data on one slide. Let's turn it over to Nicole.
Oh my goodness. So we've had some fun, some roller coaster rides on the economy and what's happening with interest rates. I'm going to do a quick 2-week look back so that we can kind of go over both of these and kind of show you where we started, where we landed, because it was a little frustrating last week. It was a short week, and then it was low trading volume, and then we had unemployment drop. We had 500,000 jobs created for ADP, and it was all kinds of things. And so if you guys are getting our texts, we sent out a text yesterday with the CPI numbers, just letting you know that it actually rebounded quite well in our favor. We send out a text every Friday or when news comes out. So I'm going to share the screen really quickly and we'll go through what's going on in the economy. So, all right. So last week we had this 10-year breakout, and I want to double click on this because it does speak to this new trend line that we created. Now I'm listening to the Dave Stevens and I'm seeing the MBA report, and it's talking about us seeing interest rates in the high 5s by the end of this year. But we have to see a certain number of things happen between now and then. We have to see that the Fed stops after this next July increase in the Fed rate. We have to see inflation continue to tick down. We need to see the stability in the financial markets, where we see the 10-year and the 30-year spread start to decline. So there's a series of things. And I'm not going to say I sit here and say I'm smarter than Dave Stevens or the Mortgage Bankers Association. I'm not. But what I am is looking at this data, and I'm not wanting to get too exuberant yet. What I'm trying to do is be more strategic to say, if that happens, I'm going to be in a position to take advantage of it. And that's phenomenal. But if it doesn't happen, am I positioning myself to continue to have conversations, leads, and activity? And when it does, I'm going to take over that market share. So we're still seeing activity. We're closing a decent number of transactions every single month because people are buying in this market because they know that the frenzy that's going to happen is going to give them the opportunity of increased value. That increase and that pop of appreciation is net wealth, right? I mean, like, let's just strip this down and talk about to the client, the opportunities about getting out of fear and into action is the very thing that's going to propel you further in your wealth development and your financial stability and security. Because I can sit here and say that the stock market had the best 6 months, the first 6 months going back to 1983. And that's fantastic if you've got a fantastic stock chooser. I don't. I believe in real estate. And I know that with 3 or 5% down, or even less than that with down payment assistance, I can get into the very thing that will propel my wealth through appreciation, right? And this is the opportunity. Like, I'm giving you the crystal ball that says that when those rates drop down and the demand sparks, and I'm going to show you a series of slides at the end of this presentation that you're going to want to grab and put onto social media that says, this is why we're so strong right now. This is why demand is so hot right now. And this is why it's going to continue and push home prices up further, because I'm not seeing inventory loosen up, which is a little scary. All right. So the 10-year broke out. So we just have to double click on that for a minute because it happened and it created a trend line. So it popped out past the trend lines where we were really zeroing in on this like 3.6%. So it went above 4% again, which created a higher pattern of interest rates. So these highs started getting higher. So we were starting to tip a little bit further and get a little bit higher. Now it came back down again. So now, of course, we're back down below 7%. But that trend is not a healthy trend. I don't want to see that, because then you also hear people talking about, as many people are talking about 5%, you have people talking about 8%, right? So stop counting on either one and start focusing on the strategies that will take advantage of either, because people are buying whether interest rates are 8% or 5%. Now, more people are buying at 5%, but people are buying in either situation because life continues to happen. So the FOMC meeting minutes were released in the middle of this week, which was a short holiday week where the interest rates were going higher. And of course, the FOMC meeting minutes were released talking about the fact that they see that jobs are too strong, the economy is too strong, and we're going to have to continue with 2 rate hikes. Now, the market does not believe that, and I'm going to show you that in just a second, but they're saying it's going to happen. Now, we want to pay very clear attention to what Powell says the week after next when the Fed meeting comes out. It is almost a guarantee that they're going to raise the Fed rate a quarter. What does that mean to you? That means that your HELOCs are going up a quarter, your credit card interest rates are going up a quarter, the car loans are going up a quarter. So it affects our consumer debt, not necessarily the people that own homes and are locked in. They're inflation proof, and they're certainly proved against what the Fed is doing. Part of the reports that came out, 1.6 jobs per unemployed person, a very strong jobs market. It is only 10 o'clock and I've already lost my voice. No. Wow. I got to stop talking so early. That's what happens when you get up at 3:30 in the morning. What time did you get up this morning?
I got up at 6. I slept in. I've been up at 4 o'clock every other day this week, but I slept in God. 6.
Maybe I should have, so I'd still have a voice still. My battery is almost dead on my phone.
I know, that's the problem. My battery is dead by 11 o'clock every morning.
Makes no sense. I'm like, that's not even okay. All right, 1.6 jobs per unemployed person. This simply just speaks to the strength of the jobs market. It is going to carry us through whatever level of recession we hit, whether we hit a recession, we don't hit a recession. It is going to be soft, it's going to be short, and it's going to be very narrow. It is not going to be deep. So this, or shallow, I guess I should say. It's going to be very shallow. This recession is going to be very quick. It's almost going to be this blip if it gives Powell what he needs to see. So the ADP numbers came out, up 500,000 jobs, but the real numbers I want to show you, the job stayers, their wages increased per ADP, which is different than the BLS, but per ADP, their wages went up 6.4%. Job changers went up 11.2%. But the number that stuck out to me was leisure and hospitality was up 232,000 jobs in 1 month. So they've recovered 96% of all the jobs that they've lost. At this point, at some point, you're going to start cresting, and we're going to see that coming way down. Now, the BLS didn't fare nearly as well. It was only up 200,000 jobs, which is certainly on a downtrend, but it's still strong at 209. Now, but the BLS wages were still up at 4.4%. So again, strong wage growth. And with the latest CPI, now people are making more than inflation. So that's the good news. So inflation happened. So we actually had the headline drop all the way to 3%, and we had core drop from 5.3 to 4.8. This is a number we need to keep seeing, but we expected this. So the number that fell off from a year ago was 0.6. Now, we didn't expect it to be this low. It actually came in at 0.16. We've been rounding to 0.2. Last month, it was 0.4. It was expected to come in at 0.3. So it came in less than last month, less than expectations, and a lot less than a year ago. So that 0.6 dropped off, which is why we saw that the drop from 5.3 to 4.8. Now, next month, we're not going to see as big of a drop because it was 0.3, unless we see this like 0.1, 0.15, 0.16. Now, that's what we need. 2% needs 12 months of 0.16. So I kind of keep coming back to this. Like, I want to be like exuberant. I want to be super excited. I want to go, this is the end. Like, we're there. We're not there. We're not there yet. It's like we're at mile 20 when we've got 100 more miles to go. We still have to see this pattern of this lower inflation to get back towards the Fed's desire of 2% on the core, because we're already at 3% on the headline. So just watching this, being able to celebrate every time it comes down, being able to watch the interest rates slowly come down, and continue to talk to people about the fact that we are expecting interest rates to go down. Can you afford at today's budget? Does it make sense? Does it cash flow if you're an investor? Because it's only the opportunity to improve that situation when the opportunities for refinancing present. So the rates dropped back down below 7% with all of this news. Really, the national rate is like at 6.88 right now. We're certainly seeing people locking in below that, which is fantastic, because the 10-year dropped. So the 10-year dropped from over 4% to 3.8. When we sent out that text blast yesterday morning, it was before the mortgage rates dropped, saying where the 10-year opened. Because remember, the mortgage rates are hovering 3.2% over the 10-year. So if I'm telling you what the 10-year is doing, you know what the 30-year fix is doing. They're hovering at 3.2. When we see that 3.2 start to come down, we're going to start to see rates drop faster than inflation is allowing them to drop right now. So certainly being paying attention to this. So the rate, Fed rate expectations for July, the week after next, it's a done deal. They're going to raise it a quarter, but everyone in the market is expecting that the Fed is full of hot air and that they're not going to raise the Fed rate in September. Now, Powell will probably stand tall to say that he is going to raise the Fed rate in September, and this will be a market debate. If he ends up raising the Fed rate in September, the markets won't like it. So we will continue to see volatility. If he doesn't and he decides to hold based on where the data goes over the next 60 days, because we don't have a Fed meeting in August, we could see that they end up holding, and then the markets are going to celebrate that. So to say that we know what the market is going to do is really dependent on whether he holds or he continues with these Fed rate hikes. Jobless claims just came out this morning and they dropped. So now we've got job market resilience continuing. We're seeing wage resilience. Wages are continuing to stay strong. That means employees are continuing to stay confident, and jobless claims are dipping again, going back into that range. We had broken out and we're going right back into it. So we're not going to see this massive jobless claims where we're going to see unemployment spiking up, which is exactly what Powell wants. We're not going to see it. We're not going to see a jobless recession. What we're going to see is people moving or diverting their funds to, say, different choices. But interesting, I was listening to a CNBC interview with the CEO of Delta this morning. Of course, they came out with extremely strong earnings again. Everybody is buying premium priced airline tickets. So their first class sales tickets are all up. The Amazon numbers came out and they jumped up I think over 30% in sales from last year's Amazon Prime Day.
You're kidding.
There is no slowdown going on right now.
No, there's not. I mean,
There's-
I honestly wonder, is there going to be a recession?
It is.
Are we going to have a recession or not?
At some
Because
point,
it's like, it's not happening.
people are still spending. They're getting a little choosy, but people are still spending.
Yeah.
So 30% increase. You guys that did Amazon Prime, way to go. You have the numbers out. Mortgage purchase applications were back up 2%. So they had dropped 5% last week. They pushed back up again. This is the buyer resilience. All right. So this year to date, we've had several spikes above 7%. Yet we've had 14 positive weeks with mortgage purchase applications and 13 negative prints. So we've had a very balanced buyer market. They keep trying and they keep coming out there. So watching that is just continues to say the buyers are there. The mortgage purchase applications are coming in. They might not find the home right away, but they are getting ready. So lean into that and support your clients, because if they're not buying this week or this month, they're certainly buying and they're buying soon. Personal savings actually went back up again. So it's 4.6%. So again, consumer resilience, they're still okay with spending. In fact, a report was just printed out saying that the baby boomers have $75 trillion. They're ready to spend.
Wow.
$75 trillion. Gen X has 40 trillion. They still have this money. So we talked about the excess savings from the pandemic has been spent, but they still have this massive net wealth through their real estate values going up, through their stock market values going up. These guys still have wealth, and that wealth is getting transferred. So skipping over the Gen Xers, because I feel skipped. And it's going down to the millennials. I'm talking to these millennial buyers that have millions in trust accounts, in their named accounts, because it was gifted to them from their baby boomers or older grandparents or parents. So we're seeing this happening for 75 trillion. And then we have delinquencies near record low. We have a ton of buyers sitting very strong. Almost 40%, 38% of homes don't even have a mortgage on them. And those that do, the majority have interest rates below 5%. And then we have this delinquency near record lows. Homeowners are resilience. And then what we have beyond that is we have the birth rates. So demographics are absolutely on our side. So right here, this is from 2021. So if we're talking 2023, here's our age 34. So here they in 2021. So age 34, we are right at the top. The most Americans today, the highest number population are age 33 and 34. They're ready to purchase. And then I went back to age 14. So 20 years, if you look, I have to go before you get to where what is that? That's the baby boomers, age 62. In order to get lower than that, you have to get to age 14-year-olds right now. So we have 20 years of demographic demand pushing on limited supply, holding purchase prices up, feeding into the new build inventory demand, right? So builders are going to be sitting in a position of opportunity. We know that existing home sales, if you price it right and stage right, you're going to have probably multiple offers unless you're on a busy road, and you've got opportunities to get into the market and continue to build net wealth, because a lot of Americans right now don't have the money to put it in the stock market to create millions. But you can put $30,000 down on a $525,000 home, and in 20 years, you're going to have over $1 million. It's how you create millionaires, is through buy and hold real estate. In fact, NerdWallet, January of this year, so this is a little dated based on what we're seeing in 2023, but January of this year, NerdWallet came out saying that 28 million people want to buy a home. What we're seeing is 3 to 4 million are actually buying homes this year. So what does that say? Pent-up demand is coming in 2024 and 2025 and 2026. This is the strategy we keep talking about, right? The opportunity. There are going to be people that leave this industry, but then there are going to be people that keep resting on their laurels. They keep resting on the way that they've always done their business. And those who take advantage of opportunities to gain skill, to gain an acumen, to gain more market share in creating right now while the market is a little bit slower. In fact, National Mortgage News just came out with a report, 64%, and I had mentioned this the week before last, 64% of consumers who are wanting to buy are sitting on the sidelines waiting for those interest rates to drop. And we know affordability is tough right now, but we also know buyers are getting in. They might just have to choose different locations. What I don't want to let us get into the conversation, and I'm gonna land this plane here, is if affordability is high, and I actually just did the Tuesday live on this, it's an awful time to buy.
Mm-hmm.
Is that right?
I watched that and it was like,
I don't know. Why am I saying purchase prices are high, interest rates are high, affordability is a 37-year low. You've got all of these things stacked up against you. To say that it's not a hard, a difficult, a terrible time to buy is avoiding the obvious because everybody's thinking it. But to say that you're going to sit there in indecision and stop buying because of this fear or because it's a bad time to buy, you're not thinking, we've got to start talking strategy. What's 3 to 5 years from now look like? Why do you want to get in now? Because I'm going to paint a picture so clear, a vision so strong about where you want to be 3 to 5 years from now that you want to get off the fence and you want to become a buyer in this market right now before all those buyers, the 64% of buyers sitting on the sidelines waiting for interest rates to drop. Because rents are declining and it's getting super comfortable to stay renting. We have to be the voice of reason. We have to be speaking into our wannabe buyers are renting right now because right now they're feeling comfortable there. And if you guys want to take advantage, we know that there's a ton of condo development going on downtown right now. If you want to take advantage of owning that market, understanding how to list and to purchase condos, you want to join us next week. We're not going to be going live on Facebook. We're going to be doing the market trends update in person at Columbine. And we're going to be talking about condo market and how to own that market. And then, of course, we've got one of my fan favorites, Kristen Messerly, is going to be talking about Gen Zers next month. So make sure that you do sign up for this. We'll have the RSVPs for Megan and I when we send those out.
Couple of questions down here. So let's see. Oh, okay. Thank you.
I don't know what that was.
I keep hearing how good the jobs market is, but I keep having conversations with folks that are having a terrible time finding a job. What are your thoughts?
We're seeing a transition of jobs, right? We're seeing this initial jobless claims pop up, but the continued claims is staying low. So that continued claims is people that are staying on unemployment. And that initial jobless claims, we're seeing a transfer of people from maybe the IT markets, the real estate market, the mortgage market, those industries that grew exponentially during the pandemic don't have that need today. And you're also seeing a lot of companies who are using technology. In fact, there's another CEO that I was listening to, Pepsi, they were talking about how much they were automating right now and how much money they put into technology. They were also laying off people in order to streamline and to maintain margins. So you're having people that are being removed from those jobs and then are entering into hospitality jobs, leisure jobs, service jobs, where there is a big need and a recovery from the pandemic where they were losing people. So people have to retool their skills. They might not get the same job in the same industry. They might have to look outside of that industry that they've been comfortable with.
Awesome. Wow. We are 7 minutes early today.
Yeah. I talked really fast that one.
Yeah.
We got that done.
Yeah.
Time. We can have people to go to the pool.
I know.
Yes.
It's time to get outside, guys. It's
Yes.
Summer feels like it's finally here.
Yes.
So get outside, go enjoy your pool. So why do we do this, Nicole?
I know why I do this.
I have a very specific reason why I do this.
Why don't you share this time?
So the reason why I put this together is I want to do my part in making sure that you're successful out there, advising your buyers and sellers as to what's happening in the marketplace. And my sincere hope is that if I'm able to help you create more transactions, that you'll repay me with your kindness by sending business over to First American Title into my teams over in Lodo, Cherry Creek, and Denver Tech Center. So I hope that we'll get to see you guys at our closing tables if I help you get to a successful transaction.
I would say the same thing. And, guys, we're saving a lot of deals right now. There's a lot of lenders who are getting into the space that were either refinancing, they weren't doing a lot, and they're still not doing a lot. And they're not seeing a lot. If you're not doing a lot of transactions, you're not seeing the things that can curve that ball way left. So the Ruth team is continuing to provide that level of service and expertise, and we're saving the deal. So give us a call if you need that, but really give us a call in the beginning. We'd love to serve your clients. We'd love to see you at the closing table. We do this so that you can get your clients and build your database.
Awesome.
Yeah.
Well, thanks so much, guys. We'll see you next week live. We will be recording it so we can send it out, but we would prefer to see you in person.
Yes.
So please make the extra effort to come on down, learn about the condo market, get your weekly market update, and we'll see you next week. And then we'll be back onto Zoom the week following that.
Agreed.
All right.
Sounds good.
Thanks, guys. We'll see you soon. Have a great day. Bye.